Gbolahan Ologun, research analyst with Codrus Securities, joins us now. Good morning, Gbolahan. Thank you very much for joining us.
Good morning, Chimizi. Thank you for having me.
Okay, let's start off with this negative trend that we are beginning to see in the equities market. Now, is this the beginning of a market correction, or is this just a temporary price adjustment before another rally? Or would you say there is a market crash ahead?
Yeah, so I think since the start of the week, market performance has been broadly bearish. Cumulative loss as at the close of trading yesterday stood at 0.97%. So for us, we think on Tuesday, which is the trading day that we had the highest loss, we think that was a knee-jerk reaction given the uptick we've seen in fixed income markets, particularly long-dated bonds. So we think for some investors, panic sales more or less dominated their reaction to sell down their portfolio rather than fundamental factors. Nonetheless, we don't think that it is an event that would persist in the short term. And if you look at how market trended yesterday, there was moderation in the loss in the all share index down by just about 0.2%. So we think it is reflective of the fact that some investors took advantage of the moderation in the price of major bellwether stocks in the prior trading day to make re-entry into those stocks with sound fundamentals and have good history of dividend payment. So with the full year 2020 earnings season already in motion, we've seen corporate earnings from banks, the likes of First Bank, Stanbic, and Fidelity Bank. We've also seen earnings from the likes of Flour Mill and Guinness, which I think on a broad scale, it has been broadly positive, more like decent earnings. So we think investors would continue to search for positive real returns in the equities markets, given negative real returns in the fixed income market. As a result, we think that they are likely to rebalance their portfolio towards the equities market, which should remain supportive of a broadly positive performance. And I think thus far in the year, we've started off to a very positive note. As that in the month of January, the Ocean Index was up by 5.3%. So we expect that positive trend to persist in the short term.
Well, many will argue that the uptick we've seen in the bond yield could be the reason behind the sell-off by investors, as they expect a continuation of the uptick in bond yields. Is that a case?
Yeah, certainly. I think there is a strong argument with regards to the uptick in yields driving negative sentiment in the equities market. But for us, we think yields in the fixed income market are likely to remain at current levels in the particularly in the first half of the year, due to a number of factors. Firstly, if you look at the outcome of the last MPC meeting, the central bank governor struck a dovish tone, which indicates that they are likely to maintain an accommodative monetary policy stance in order to support economic recovery, when you consider the fact that the Nigerian economy is currently in a recession, given 2 quarters of decline in GDP growth as at Q3. So we think that monetary policy would remain supportive of lower yields in the fixed income market. In addition to that, we think the DMO is also aware that investors are demanding for higher yields due to the expectations around inflation, which remains biased to the upside. In addition, investors also expect the Debt Management Office to front-load the bulk of issuances of domestic debt instruments in the first half of the year. But nonetheless, we think DMO will try to resist the urge to offer very high yields to investors, given pressure on government revenue that would also weaken the ability to service their debt. So debt servicing cost is also a concern for the DMO. So in that regard, we think they would resist the urge to drive yields at the bonds auction that will take place subsequently in the first half of the year. So for us, we still expect yields in the fixed income market to remain depressed at current levels, despite investors' demand for higher yields.
All right. Now, you did mention the earnings, of course, being in the earnings season. So how should investors trade this earnings season, given expectations of full year 2020 financials to be published by major bellwethers across the banking, consumer goods, and industrial sector?
Okay, so I think one major sector that has been the toast of investors is the banking sector. And if we are to take a cue from banks that have released their earnings thus far, the likes of Stanbic, Fidelity Bank, and FBNH, we think it's been more like decent earnings, although growth in bottom line has been uneven. So we think the major pressure point for banking stocks remains the fact that the low yield environment has put downward pressure on interest income, more so that banks have not also expanded their loan book given soft macro conditions. Nonetheless, we still think that there are some bright spots that would support banking performance. For instance, banks have been able to make significant savings in terms of cost of running their branches, given that they are not operating at full capacity. So for banks who have been able to deploy cost optimization strategies, that should support their bottom line. Aside that as well, we think for banks who also have net long position in terms of their position in foreign currency, we think they are also able to book foreign exchange gains that would support profitability. And in that regard, you look at the big names in the banking sector, the likes of Zenith and GT, who also have strong capital buffers that would enable them to absorb asset quality issues emanating from the poor macro conditions in the economy. So for us, we have somewhat decent expectations for banking earnings in 2020. And we think for the likes of GT Bank and Zenith Bank, who have a consistent history of dividend payments, investors should continue to take positions in those names. Aside the banking sector, we still think that the cement sector is also a space where investors should take a good look at. We think in 2020, in the first, as at the end of the third quarter, we saw strong top line performances from the three major industry players, and we expect that to persist in the fourth quarter, although we don't expect that I would see the magnitude of expansion in revenue in Q4 compared to what we saw in Q3, given that the private sector were also affected by the protests we saw in the month of December, and persistent liquidity in the FX market has also hindered activities in the construction sector due to increased cost of building materials. But nonetheless, we still expect these cement players to also deliver decent earnings in 2020.
Okay, well, still talking about earnings, a few results we've seen majorly on audited result. What is that signaling?
Yeah, so why we've seen unaudited numbers from some companies is that the Nigerian Stock Exchange has made modifications to the release of corporate earnings. So companies are now allowed to publish unaudited numbers not later than 30 days after the end of their financial year, and 60 days if you decide to publish the audited financials. So that's why we've seen the likes of FBNH, Stanbic, and Fidelity Bank publishing their unaudited numbers. And I think across those three major banks, the only bank that was sort of disappointing in earnings was just Fidelity Bank. But for FBNH, we saw decent expansion in profit before tax. Same thing applies to Stanbic.
Okay, so we've seen the NIN SIM linkage extended, but what impact do you think the ongoing exercise will have on telcos' GDP?
Yeah, for us, we think the telecommunications industry is one of the fastest growing sector. And if you look at the GDP numbers, that sector is more like the bright spots, given the broad weakness across major sectors in the economy. So we understand that since government came up with that policy last year, the industry players, MTN, Airtel, have been restricted from onboarding new customers in terms of registration of new SIM cards. So we think that would likely suppress growth in onboarding of customers in terms of how they're able to gain new customers across provision of data, which would impact on data revenue and voice revenue negatively. But nonetheless, we think it is still a positive move from the government, given that in the economy, we have seen cases of people using registration numbers of legitimate customers to perpetrate frauds, armed robbery, thefts, and the like. So we think it's still a positive move, but nonetheless, it is going to have a short-term negative impact on the telco players.
Well, recent data from the NSC on domestic and FPI participation show that value of transactions executed by foreign investors declined by 22% year on year to about 729.2 billion in 2020. That's the lowest level in 4 years. What drove the decline?
Yeah, so for us, we think if you look at over the last 4 years, we've observed consistent decline in the value of transactions executed by foreign investors. So in 2018, we had hike in interest rates in the United States that triggered capital flow reversals from emerging markets to advanced economies. In 2019 as well, we also had the general elections that heightened political risk in the domestic economy, and investors had to also reduce their exposure to the country. But 2020 was a particularly distinct year when you consider the events that characterized that year. So we had a pandemic, and that pandemic sort of increased global risk of sentiment towards risky assets in emerging markets. And for a country like Nigeria that is vulnerable to the swings in the oil market, we saw foreign investors selling down their portfolio significantly in the months of March and April, when we saw a steep decline in the oil market. So that was the principal factor that drove the decline in the value of transactions executed by foreign investors. Although later in the year, we saw recovery in the equities market. However, Nigeria was unable to attract foreign portfolio investors back into the equities market. And we think the reason for that is due to the fact that the Apex Bank has not been able to restore liquidity in the investors and exporters window. And for us, we think that still remains a significant challenge for the country if we are to attract foreign portfolio investors back into the equities market. And based on our interactions with foreign investors, we think one of the factors they are looking out for in this year, if they are to sort of return back to the equities market, is to have improved flexibility in the foreign exchange market alongside improved liquidity conditions in investors and exporters window. However, they are also looking forward to structural reforms that would also sort of de-risk the Nigerian economy from its vulnerability to swings in the oil market. So we think if policymakers are able to address these two major factors, certainly that will put the country in a better position in reversing that trend of declining value of transactions executed by foreign investors.
Okay, so going forward, what should we expect in 2021 in this regard?
Yeah, so I think in 2021, we still expect domestic investors to remain the key driver and continue to dominate and dictate the tempo of market activities in the equity space, given our expectations of depressed yield environment, particularly in the first half of the year. However, in the second half of the year, we expect that the central bank is likely to revert to a slightly hawkish stance in order to focus on its core mandate of price stability and also stabilize the external sector. So we think if that goes in line with our expectation, we are likely to see some form of sell down from domestic investors as they reduce their exposure in equities in order to take position in the fixed income market. So for us, we think 2021 is going to be a tale of two halves. The first half, we are likely to see markets more or less showing a broadly positive performance. However, in the second half, when there is a change in monetary policy, which would push yields in the fixed income market slightly upwards, we are likely to see some form of sell down. However, we don't expect the sell down to erase the bulk of the gains that would have accrued in the first half of the year.
Okay, we'll see how that how goes. Thank you very much, Bolaho, for your time.